actually the first time we do this all together on a panel during the forum, so it's very exciting for me. Last year was marked by inflation going up, rates going up, slowdown in liquidity, slowdown in activity, and we're starting this year with a market actually being quite, I would say, resilient, and economic indicators turning somewhat negative. So my first question to each of you separately is, how did this macro environment impact your business line over the last 12 months? And I'll start with you, Sherif, with the secondaries.
So, big picture, obviously 2022, credit markets down, equity markets down, brings fund prices down. And so for me, I step into 2023 with a whole lot of supply of funds coming to the market, and that's driven by two things. Item number one is underlying funds have been distributing less. I've been hearing that from a lot of people today talking about that, and obviously seeing it myself. M&A markets had shut down to a certain extent last year. Financing markets, capital markets, equity capital markets shut down 2022, so less distributions up. And so what happens is sellers come to the market to obtain liquidity, to fund other capital calls, or they're over-allocated to private equity and need to reduce their exposure. So that's really the primary way, right? You come into a year like this year, flooded with potential supply of fund interests.
Great. And Rob, on your side, the buyout market is quite different. Sherif just gave an overview of the overall private equity markets and the flows in that segment. On the buyout side, you're exchanging more with fund managers, and the activity is a bit different. How did it impact your?
Exactly. And so the strategy I lead is about co-investment, and we co-invest with the mega funds like Blackstone and Carlyle, but we go all the way down to newer emerging managers, and you'll see some today like Baylink and Gearbox Capital. And in short, what happened to us in the macro in the last year is the volume is way down. Deal activity of these groups is declined, and I'd say there's really three drivers of that. Traditionally, these private equity sponsors rely on three sources of capital. They need traditional fundraising. They raise blind pool funds. They have large LPs that provide a lot of co-invest capital to them. And they have the credit markets. These are leveraged buyouts, so they need debt to make these deals work. And really all three of those things got tightly constrained last year. The fundraising market's incredibly tight as LPs lean back. Many are over-allocated to private equity. Those same LPs are no longer writing big checks to co-investments. They're trying to pull back to get their allocation correct. And then, of course, we all know what happened to the credit markets, where not only did the amount of debt that was available to sponsors come down, so the leverage levels coming down from, on average, 6 times EBITDA down to something closer to 5, but the ability to get that debt, so it was less, but it was also harder for sponsors to get, and it was much more expensive. So really, the confluence of factors drove a pretty big decline in volume of LBOs, and so something like 20%. So I think that's the headline. And we've had to navigate through that.
Thank you. Charles, obviously, I think everyone knows what happened in the venture space was the aftermath of the SPAC IPOs and all of that. But could you give us a sense of how the macro environment impacted the venture space?
Definitely majorly impacted. But when we met here last year, I think people were still hopeful that somewhat we could weather the storm, but we've seen the lag or the market catching up, and in 2023, the data that we're seeing thus far is pretty compelling when it comes to volumes, the number of deals. I was looking at the European data for deals, we're back to number of deals probably 2017 levels, and in terms of value, we're probably around 2019. Everything, all the craziness we've seen throughout the COVID years has been erased, and so I think that we're probably at a level that is the more organic and natural level for the asset class versus the exuberance that we'd seen in 2021 and 2022. Yeah, that's really the biggest impact and headline, I would say, on the market.
And so I know we share with some of our investors the exact data around this, and I just want to share some specifics on bringing what you just said. In 2021, the peak in exits and distribution was 2.5 trillion in exits. The average year in buyout on private markets was more 500 billion in exits. The last year, it dropped to 300. So that shows you that we grew a factor of 5x and dropped by that same factor. And that's what we're talking about. In deal values and volumes, I think it's down 10-20% Q1 over Q1. So these are real stats where we're seeing the data kind of impact all of the business activities. Nonetheless, I'm sure that people are seeing, there's a lot of flow. People are saying it's a great time to invest. So I'd like to go in reverse order. In this uncertain times, what opportunities might you be seeing, or what focus you think makes sense in the venture space?
So, what we're seeing with our existing portfolio companies is that they all grasp, I think, the new reality. And so for those who weren't profitable yet, they've all been urged to find a path to profitabilities. And so I think what we'll see is a greater divergence between those who need to raise money because it's a matter of survival, and those who are can survive on a standalone basis, but just want to accelerate or gain market share or so on and so forth. So actually, I think it offers us the opportunity to be very focused in our approach. And because there's also less competition among investors, I think you mentioned SPACs. We know that the asset class has been floated with what I like to call a lot of tourist investors. While those, unfortunately, have been probably burned for the most part, and therefore have retracted from the market. And so we're seeing, less competition, and probably we have more time and opportunity to do a better job at selecting the best opportunities.
Are there any markets or sectors or regions you would like to highlight?
Definitely. We talked about it even with in the earlier sessions, starting with Thierry. I think AI is you can't ignore it. Now it's obviously a broad term. Generative AI being the excitement that everyone wants to capture. We have already invested in companies that are building AI-powered applications, and will continue to dig further into that, alongside with climate tech. I think this is, the need for sustainable investment has not decreased. And if anything, this is probably also how we can get out of this crisis and rejuvenate growth as well. So those are two of the overarching theme. Otherwise, I think we continue to see good disruption, disintermediation happening in the fintech world. So I would say these are the three main areas where we continue to be active and sourcing deals. And when it comes to geographies, we are actually very excited about the opportunity to be more focused on our backyard, the Swiss tech ecosystem. And that's how we built our team to tackle that opportunity.
Great, thank you very much. What I heard, two words I'd like to highlight is the importance of selection. We heard it on AI. AI is actually more of a feature and application to disrupt traditional businesses, and we're seeing the mega companies actually lead the charge on that, so it will be hard to think. So selection is really, really important. And the second is divergence. One thing we've seen is, while in the past maybe some sectors diverge from each other, or markets diverge, now we're seeing within the same sector, within the same countries, business models that are just taking totally different routes. And we can share dozens of examples of that, but we think that business model pertinence is actually the key thing in this market, not just calling sectors or markets. But very happy to be building the Swiss ecosystem. You know how dear that is to me. So great to have your team, and I think you and some of your teams will be on panels tomorrow. So
indeed, yeah, we'll bring some of the founders that we've already invested in that are part of this wider Swissness universe, but also founders from our existing portfolio, such as Grub Market founder. And so while we are very excited about this new opportunity, we also want to continue to cater to the winners that we've already invested in.
Thank you. Moving on to buyout, and Rob, I know you also have a panel later. There's some changes in the schedule because of arrivals, but do you want to tell us what opportunities you're seeing in the buyout space and how you're capitalizing on that?
Absolutely. I started with the macro news, which is deal volume's down a lot. I'm pleased to say that our deal volume has held up very strongly through this period. How are we able to maintain our deal volume? We see about 230 deals a year, and we invest in about 5%. How do we maintain our deal volume when the market was collapsing? And there's really, I'd say, two main reasons how we did that. One is, if you look beneath the surface, not all segments are equal, not all sizes fell equally, and we found particular strength where the mega funds, for instance, really had trouble with financing and deal volume really collapsed. We've invested quite heavily in building relationships with smaller GPs, emerging managers that operate in the sub $500 million deal segment. You'll see two of them later today on a panel this afternoon. But that's been an exciting growth area for us, and we've been leaning into that for several years and benefited from that last year. So that's one reason we held up our market share. The second reason is I mentioned all the things that are constraining sponsors right now. They can't get fundraising done, their LPs are stepping back, and the credit markets are lousy. In that environment, it's very nice to have capital, which we have, and to be actively deploying. We're just in the process of raising our Fund 5, so to have that committed capital has been terrific, and it really allows GPs to view us as a trusted partner that can help them get deals closed. Specifically, in terms of where we're seeing opportunities, as I said, it's nice to have a large funnel, seeing over 200 deals a year, because right now in this environment, if you're a seller, you may choose to not sell because, in fact, the market's not very strong for selling private equity assets. But there are some sellers who have to sell for whatever reasons, liquidity, change in management, anything else. And those can set up very interesting situations for us to buy things at a big discount. So we've been seeing this in the last several months. We're very excited to have this brand new pool of capital to take advantage of this trend of, I would call kind of forced sellers who have to sell in this environment. And beyond that, I think similar to the other strategies at ACE, we focus on themes. The three themes I'll mention for where we're active: climate, IT, consumer. On the climate side, we just invested in the largest compressor company for HVACs. They own 70% of the market share for the compressor that goes into HVAC units. That's just part of a warming climate. We're going to need more HVAC. That's part of the problem in terms of more demand for HVAC, but it's also part of the solution in that we need more technology, better technology, fewer refrigerants, more energy efficiency, more heat pumps, and this company's at the leading edge of that. So that's an example of a climate theme we're behind. On the consumer side, not surprisingly, consumers want to look and feel better and eat more healthy, so we've leaned in heavily to food options that are better for you. We invested in a medical dermatology spa for clients that want to look more youthful. So that's the largest spa chain in North America and growing very rapidly. So that's a trend we believe in. And then on IT, it's you'll see later today the sponsors we've invested with are doing things like more offshoring, Indian programmers, vertical software businesses, data centers. So we're really just trying to capture a lot of those growth trends in our investments.
That's great. Thank you very much. You actually took us through not only the types of deals and how we approach on the different types of financing and how companies or how deals come about, but also the type of sponsors working more with emerging managers versus established sponsors, and got into the specifics of actually how I think you are a micro investor. You're talking about specific situations that fall within that macro picture. We're not macro investors. We don't make macro calls, but these macro assumptions go into driving the flow and the selection. So thank you very much for that. I think this gave a great overview of the buyout market. I'll finish with Sherif on the secondary market. As you talk about the market as a whole, what are the opportunities in this market? And investors are probably getting flooded with opportunities today, with secondaries, with different things at discounts. How do you filter through that? I think the number you shared earlier was 600 billion
That's right.
Yeah.
So, I've said it probably 500 times today, but it's a good time to be a secondary investor. And the reason for that is this: $600 billion of NAV still sit out there from pre-2011 vintages, right? So that is at least 12 years old and probably has another 5 years to go to get fully resolved. So that's number one. Number two, $6 trillion of capital committed to private equity, all private equity, between 2010 and 2018. Now, I don't know what the NAV of that is, but it's definitely in the trillions. So if you take a rule of thumb, you say approximately 2% of NAV trades on an annual basis, and a decade ago, that was only 1%. So if you say it's 2% today, you're looking at somewhere between $100 to $200 billion a year of fund trading for the next few years. So that's a big opportunity set. I think the second thing is this, is like, and Adam, you heard me talking about this earlier with Jason Thomas, but the secondary market is not taboo anymore. There was a time when, let's say myself and person X had an agreement to do a deal, and person X reaches out to the GP and says, I'm going to sell my interest. That was virtually a death sentence, right? If you went to Carlyle and you said, I'm selling my fund interest, good luck getting back into their next fund, right? It is not the case at all anymore. Secondary or GPs are very accommodative of secondary transfers. They know why it's happening. And frankly, it's very important to them to be able to raise money because they know that at some point in the future, that LP may or may not want to access the secondary market. We're doing a deal right now, 9 different funds, and it's the first time I've seen this. 3 or 4 of those funds are the type that you would expect would be a bit iffy about a secondary deal. And the email went out introducing to us. And yeah, great, happy to help. Here's the docs, et cetera, et cetera. That wasn't the case a decade ago. So in this market, lots of volume, pricing is down, sellers are not getting the type of capital back that they got in 2021. Like you mentioned, Adam, $2.5 trillion. When that dries up to a few hundred billion, you can understand that people's cash flow estimates that they might have built in 2020, 21, 22 are no longer what they thought they were. So lots of deals to be done. You've got to be careful. There's a lot of junk out there. We try and avoid the junk. But there's a big enough playing field to do some good deals.
Yeah, you were saying earlier, I like that on the 600 billion, there's probably 1 or 2 billion of good value there. That's what you want to go for, not just the broad market. I'll have to wrap this up because I realize we're on time. I thank you very much for joining me on stage. What I wanted to do and the purpose of this session is really to show how the private equity markets have evolved tremendously in the last 10 years, and that the approach of the multi-stage actually gives a good insight of understanding the market level trends at Sherif's level, what's flowing where, understanding the GP and how deals are being made, what's leading the market with Rob, and then with Charles talking to CEOs and being at the forefront of that innovation. And it's when we can collaborate across these 3 that we see the most value. So I hope this gave a good overview of the private equity landscape as a whole. I'm sure there's plenty of other things and other takeaways you'll get from our other sessions. So we'll leave you to go back to the agenda. And thank you for joining me. Thank you.
Thank you.
Thank you.